there were a lot of hopes, that they would do things properly. Bahamas has a very good security laws framework. There are a lot of multinational financial institutions here, funds, hedge funds, banks, similar to the Caymans, by the way. So it's not a jurisdiction that didn't see significant players coming in, but obviously, crypto has that context of a future. So everybody was excited. Now, did FTX necessarily apply for the correct license, or did they operate from the get-go with being honest and being transparent with the local regulators? I don't think that's the case, actually, but there were a lot of hopes, obviously.
Well, you're operating there as well, and I am curious about the regulators there in the Bahamas. They must have been pretty excited to kind of have yourself and Sam Bankman-Fried here. I mean, this idea of creating another financial hub, or perhaps the crypto hub, had to be pretty attractive. And I'm curious, what you saw, what you've heard. Again, you're within this industry, about the reception by regulators there in the Bahamas.
So the Bahamas has security laws, and under the security laws, the company's license here being banks, broker dealers, or exchanges. And for example, quantitative is a broker dealer, and it has such a license. As a United States, USA companies will have under FINRA, or in European Union will be companies under MFID2 regulations. They will operate in very similar restrictions like here in Canada as a broker dealers. Unfortunately, FTX didn't apply for broker dealer license. They applied for a license under their regulation, which is simple exchange. But as we know, FTX wasn't a simple exchange. They were basically a derivative house, and they were marketing those derivatives. They are high leveraged, and I think that's where the problem happened. And I pretty much sure that they should be smart enough. FTX people, they should be smart enough to kind of realize that while they're applying and positioning themselves as a regulated exchange, 95% of their business is not being regulated, and it did not apply, as far as I know, for the correct license that would be a broker-dealer license.
It raises the question, Lev, about damage that it's done to the industry. As our own Zeke Fox earlier in our program described Sam Bankman-Fried as being, one of the few honest guys in the crypto industry. That was the impression that people had before this meltdown. You are the founder of the multi-asset global brokerage Quant Fury. Are you worried about the damage to the industry that FTX's collapse has done? And what are you seeing on your platform to sort of reflect activity there?
Right. So yeah, I'm very much worried, actually, because we're talking so we have to separate USA investors, USA-based investors and global investors. Everybody really should realize that the United States has proper and great law enforcement framework in place, and also security laws. And a lot of people complain about SEC, CFTC, but eventually they will do the job right. We have a lot of cases in the past. Globally, the situation is a little bit different, and it's really kind of a wild west when we talk about the crypto. FTX is not just an example. Exchanges like OKX, Bybit, Binance, they have the same mode of operation, a very not clear license of exchange, while they actually market high leveraged derivatives, and none of them being oversight or regulated in that field. So so I kind of very much concerned about the industry globally. I'm not concerned about US. I'm not concerned about. So, yeah.
Lev, thank you. Forgive me for cutting you off. Lev, thank you so much. Lev Mazer, he's founder of the multi-asset global brokerage. They're called Quant Fury, and joining us via Zoom from Nassau, Bahamas. You're listening and watching Bloomberg Business Week, and this is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got 28 minutes to go ahead of the closing bell. Stocks have narrowed their loss right now. Yes, in the red on the S&P 500 index, but well off session lows. At the worst level of the day, the S&P 500 index have been down by just about 1.2%, but right now the S&P is down 5, a drop of 0.1%. Indeed, a few minutes ago, the S&P was higher, barely. The Dow in the green now, reversing earlier losses, up 21 points, up by about 0.1%. While NASDAQ is down 19, a drop there of just about 0.2%. Earlier this afternoon, we did have the Dow, S&P, and NASDAQ all in the green. 10-year yield on this Jobs Friday, 3.50%. The 2-year, 4.27%. This after the jobs report came in hotter than expected this morning. Spot gold, $17.99 the ounce, down 0.2%. West Texas Intermediate crude down 1.3%, $80.17 a barrel. Bottom line here, yes, it is a down day, but the S&P has narrowed its loss. Diane Swonk, chief economist at KPMG, says the market just is not listening to the Federal Reserve.
The Fed is willing to take a rise in unemployment, whether it be through a sharp slowdown and stall out of growth or a recession. They don't want a recession, but in their own minutes from the November meeting, they thought it was equally likely that their baseline scenario, which includes an increase in the unemployment rate, could also be a recession.
It is a down day for crude oil, as I mentioned, down now by just about 1.3% at $80.17 a barrel. Crude oil stocks are for the most part lower right now. ExxonMobil down by 1%. BP, the ADR, is down 1.2%. Chevron down 0.9%. EOG Resources down 1%. Pioneer Natural up by 0.4%. Again, recapping, we've got stocks trading little changed on the S&P right now, down by 0.2%. Again, have been down by 1.2%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie there back at Bloomberg headquarters in New York City. Carol Master, Tim Stenovec, we're on the West Coast. So, too, is our Dana Hull. She's senior tech reporter at Bloomberg News. And looking forward to catching up with her, Tim, right now, because there's been a bunch of headlines involving Elon Musk this week, a lot of them.
What else is new?
But it's not just about Twitter. There's stuff going on at Tesla. There's stuff going on about his semi. So much to get to.
Neuralink as well. With the significance of it all, it's great to check back in with Bloomberg News senior technology reporter Dana Hull, who joins us on the phone from San Francisco. Dana, we're going to get to Neuralink and maybe Twitter a little later, but I want to start with the Tesla news last night because, gosh, 5 years ago, I remember first hearing about this Tesla semi-truck and indeed orders from large companies like Pepsi. Is it finally happening?
It's happening, but not in high volumes as far as we know. So, last night, Elon Musk is a busy guy. He's flying all over the place all the time. He flew to Reno, and Tesla had an event where they sort of handed over the keys to the first semi-truck to Pepsi. And they did an event, and it was cool, but it was not like the kind of high wattage events that we're used to from Tesla, like when they unveiled the Model 3 in 2016. This was a fairly low-key event as far as Tesla events go. And, I was just home watching it on the live stream. But, yes, Tesla now has a semi-truck. On the last earnings call, they said they hope to make 50,000 of them in North America in 2024, but we didn't really hear a restate of that volume guidance at the event last night. So, how this rolls out remains to be seen, but it is important. And I live in California. The diesel emissions and the pollution and the asthma, it's horrible here. And so if we can clean up trucking, that's awesome. But it's just, as always, the question is, what kind of volume are we talking about?
Right, always, right, in terms of the specific numbers. And Dana, for our folks who are watching on YouTube and also on Bloomberg Quick Take, we just showed some video supplied by Tesla about that unveiling and about the semi specifically. You talked about 50,000 units in 2024. You say volume is so important. Could this be, though, a business for Tesla that ultimately moves the needle in a big way?
Yes, it certainly could be. There are a lot of public policy incentives and incentives from, Biden's Inflation Reduction Act to clean up trucking. And I think through the pandemic, we all saw, your neighborhood, wherever you live in the United States, is probably filled with delivery vans and trucks bringing things to your doors, whether it's, Amazon or the post office or, all of the goods. Just think about all of the goods and supplies that are constantly crisscrossing this country. And if you've ever been on a freeway, you always see big rigs. And those big rigs are a huge source of pollution. And so, the EV revolution is here when it comes to passenger cars. Trucking is kind of like the next big market segment that Tesla wants to compete in. I don't think they'll ever sell as many semi-trucks as they sell the Model 3 or the Model Y, but it is a significant, amount. And the big customer is companies that run fleets. So that's why,
right.
you see the Pepsis and the, Anheuser-Busch and Walmart kind of putting down deposits for these things. But, I think what's really important to know about... Go ahead.
No, you please finish.
What's important about trucking is it's all about the economics. Like, how much does it cost? How much does how much freight can they haul, and what's the return on the investment? Because labor costs in trucking are high. The cost of diesel is high, and so for any fleet operator, like, they're very much looking at the economics. How the truck looks is great, but they want to know, what's the ROI if they buy one of these, and is it going to be cheaper than diesel?
Is it self-driving? And I got to tell you that I was in a Tesla. Tim was in a Tesla yesterday. Our camera operator who oversaw our Stanford
this is how
remote.
It worked. Carol was Googling how to turn things on for like a half hour.
How to do the self-driving, and we figured it out. It was kind of funny. But
quote-unquote self-driving, okay?
We finally figured out where the frunk was. But having said that, Dana, just real quickly, I know, 20 seconds. Is this supposed to be self-driving semis ultimately?
They did not say anything about that last night. No, in fact, they really focused on how the truck was designed for the driver, i.e. the human driver, and how it was very comfortable for the operator. There's a central seating position. You can stand up in the cab. There's room for your coffee cup. There's room to store your gear. So they were not making any autonomous claims about this vehicle last night.
Okay, 20 seconds on Neuralink, just while we have you, Dana, right at the end here. The significance of the announcement earlier this week.
FDA approval. Elon seems to think that it's going to come within the next 6 months or so. I'll be very curious to see if that happens.
All right. Well, it's been a busy week. So great. I actually saw you at our San Francisco bureau on Wednesday, so I'm so glad we were able to get you on a week that was another busy week when it comes to all things Elon Musk. Dana Hull, she's senior technology reporter here at Bloomberg News, joining us on the phone in San Francisco. And I don't know, big week.
What did you think of that Tesla ride yesterday?
Pretty cool, but it's such a different kind of car, and we
it's
truly
so
were Googling.
It's not like these are anything new. We're just New Yorkers who don't drive anywhere, so it's like it was new to us.
Well, and it was a rental Tesla, right? That obviously
hurts.
Our crew picked up. Anyway, so it was a lot of fun.
Well, let's get over to Washington, D.C. to our 99.1 newsroom where Nancy Lyons is standing by. Hey there, Nance.
Thanks so much, Tim. President Biden admits that the measure that passed Congress this week, averting a potentially crippling rail strike, is not perfect, but he says it does provide some relief to rail workers.
We assured workers are going to get a historic 24% wage increase over the next 5 years, improved working conditions, and peace of mind around their health care. And look, I know this bill doesn't have paid sick leave that these rail workers and frankly every worker in America deserves, but that fight isn't over.
The bill that Biden signed today forces the rail companies and their workers to abide by an agreement that was reached in September. Well, it looks as if changes are coming to the primary process for the Democratic Party. Democrats have voted to make South Carolina, not Iowa, the leadoff presidential nominating state. Washington correspondent Joe Matthews explains why that decision has been made.
The strategy is to give more people of color a voice in the early nominating process, and this is not a new idea. We've been hearing challenges to the lineup every 4 years for some time now because Iowa and New Hampshire are tiny states that are more than 90% white.
Bloomberg's Joe Matthews says South Carolina would be followed by Nevada and New Hampshire, Georgia, and then Michigan. It's an effort to elevate the diverse working-class voter that helped propel Biden to victory in 2020. At the World Cup today, Switzerland leads Serbia in their match. No score in the game between Brazil and Cameroon. Earlier today, South Korea defeated Portugal. Uruguay beat Ghana. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Nancy Lyons there in our 99.1 newsroom in Washington, D.C. So a couple stories that have to do with the real estate sector that really caught our attention. One has to do with, I want to go here, kind of sellers pulling properties at a record pace as the housing market freezes. And when we talk about a slowdown as a result of the Fed raising rates, the housing market has felt it so much as mortgage rates climbed, even though they've kind of dipped over a little bit from some of the recent peaks. Nonetheless, we've seen a slowdown in the housing market in a big way.
Yeah, and for this data, we turn to none other than Redfin. The real estate brokerage said that a record number of homes are being delisted as sellers face a sharp drop in demand. So here's some numbers here. On average, Carol, 2% of homes for sale were delisted without being sold each week during the 3 months that ended November 20th, this according to Redfin. That compares to 1.6% a year earlier, and is yet another sign that a decade-long housing boom is over. Okay, hold on.
What?
2% versus 1.6% a year ago. That's not anything crazy, is it?
No, but it does wonder that we've had such a boom that has been going on for a long time. You do wonder if we're kind of peaking out, at least in this part of the cycle. And what's interesting is it says pandemic boom towns are seeing the biggest increase in homes delisted, particularly those in the Sun Belt. So Sacramento, California, saw the largest jump in weekly delistings, with 3.6% of active listings taken off the market on average during the 12 weeks ending November 27th. Up 1.6 percentage points from a year earlier. Austin, Texas followed with a 1.5 percentage point jump in delisting. So, sometimes these points, Tim, lead to a more significant trend line. And so just this whole idea that this thinking that home prices just go up, 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 it's a tight, housing market. Many home builders would still say it's a tight home market still because homes haven't been built.
And we get some numbers from Toll Brothers next week, so we'll get an idea of what they're thinking when it comes to the economy and the housing market. Real quick, Carol, Blackstone and Wells Fargo punctuate the deepening pain in real estate. Another story by John Gittleson and Patrick Clark about pain deepening across the U.S. real estate industry. You can check out this article on the Bloomberg terminal and, of course, at Bloomberg.com.
Has to do with limiting withdrawals from investors in some of these REITs.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. After briefly turning higher, the Dow, the S&P, NASDAQ all back in the red right now. The S&P, which had been down 1.2% at the worst level of this jobs Friday, now lower by 0.3%. We've got the S&P down 13 points. The Dow lower now by 31, down by about 0.1%. NASDAQ Composite Index down 45. That is a drop right now of about 0.4%. 10-year yield 3.49% with a 2-year 4.26%. Spot gold down 0.3%, lower by 5 points to $5 to $17.97 the ounce. And West Texas Intermediate crude down 1.3%. WTI $80.14 a barrel. Bottom line here: Wall Street got a dose of reality this morning after that hot jobs report fueled volatility in financial markets on bets that the Fed will keep tightening, even if that means a recession down the road. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening and watching Bloomberg Business Week on this Friday. And we want to talk a little bit about what's going on in the markets right now, because we have certainly seen kind of a bounce around in reaction, of course, to that monthly jobs report initially, right? We did see certainly pressure in the equity side of things. We saw yields kicking up. And we did see some buying, I would say about 45 minutes ago, but we're starting to see stocks once again roll over. We are in the red, as Charlie mentioned. So let's get one perspective on the market.
It's a perspective I always love to hear. We're checking in with Victoria Green. She's Chief Investment Officer at G-Squared Private Wealth. They've got about $575 million in assets under management. She joins us via Zoom from College Station, Texas. Victoria, good to have you back with us. Want to start with the jobs report, but then get your take on what's going on, big time for 2023 and what you have planned and some of these picks that you've got as well. But take us into your impression of what we saw today, given what we heard from Jay Powell on Wednesday.
Yeah, I mean, it was such a boring week. I thought we'd talk about World Cup. I mean, nothing happened this week data-wise, right,
yeah,
guys?
Nothing happened,
no.
Right? Nothing at all.
No, this week has been a whipsaw week, and you forget, we bled into the Powell comments, then obviously the huge move up, especially in the NASDAQ and tech stocks, and then a little bit of bleed back today, and then we're watching to see if this really invalidated the bear market thesis that we have, and we've run into those resistance levels right there on the downtrend, the retracements, and then the 200-day moving average, and we're really seeing if this is a true breakout or not. And right now I'm still saying no, it's a bear market rally and we're going to reverse. And that's what a lot of people are saying. You saw Bank of America, you have Morgan Stanley, you have all these people saying, hey, Q1 2023 looks a little dicey, guys, be a little careful. And if you look at what the street projections are for next year, you got 4,000, multiple people at 4,000, Morgan Stanley coming in at that 3,900, and definitely pay attention to earnings and EPS. You got 200 or 195 for EPS numbers. That's a huge EPS recession. So we're just cautioning people about the FOMO rally here, and maybe don't pile in.
Okay, so what about this rally has you concerned that it's a bear market rally, or gives you conviction that it's a bear market rally?
Well, I'm never wrong, so obviously that's my number one conviction. No.
Never. None of us are.
Ever. I was just early. So no. So if you look at the chart, it's really the chart that has me convinced this is still bear market rally. We did this summer. We rallied 17% before reversing. We made it like over 4,200, and we're running into these resistances and we're kind of bouncing off. So I look at this as kind of support of the bear market theory. We're hitting lower highs, which typically leads to lower lows. So we're looking at that 3,400 to retrace down and then hit another lower low. Unless we can decisively break out above this level and break out above that 4,150, it's to me still a bear market rally, meaning we have a lot more downside risk than people realize.
So, Victoria, there's the technical trade and then there's the fundamental trade. And to me, what's really important is, once again, what happens with earnings and what we hear. And we're wrapping up. We won't get a new earnings season until January at this point. But you talked about, kind of the earnings numbers and estimates. Where are we and what that says about valuations on the equity in the equity markets?
Yeah, sure. FactSet said fourth quarter might be actually the first time year over year we see earnings pull back over for the last 2 years, and that's X energy. And if you look X energy next year, what are going to be the ways that drive it. And I know the consumer's been super resilient. You look at the Black Friday, 9.1 billion spending, the Cyber Monday, 11 billion spending. That's great, but we're spending more on credit, and we're spending more because we have to spend more because of inflation. It's not necessarily the great top line number. So when I'm looking at earnings and I'm seeing some of these revisions and trends and some of the pressures these companies are facing, I am concerned about an EPS recession. So we talk a lot about, what's happening with the consumer and GDP, but if you look at earnings, then the probability that we're going to see earnings potentially contract still in Q1, I think is very, very high. And so if we don't have earnings growth, we're not chasing after those high multiples, because why am I paying a high multiple if I'm not getting earnings now?
How much of that is factored in, though, at this point, or you don't think it is?
I think it's factored in. I think people get too excited about the deceleration. I love the fact that we went from pivot to pause to deceleration, and now we're happy about deceleration, but it's really not a deceleration. I mean, I don't agree. I think it's 50 basis points. I saw somebody today came out and said the jobs market's putting 75 back on the table. I don't see that. 50 basis points in December. But the thing that the disconnect I see is the swap market is pricing in the Fed is going to lower rates next year, and that we're going to end up back about where we are, which is what the 10-year and the 30-year is pricing in, right? With them being lower than the 2-year and even lower than the 6 month, you're seeing the market price in a Fed cut, but the Fed has come out saying we are going to hold rates longer, higher for longer. And for me, that's a concern, because when there's a disconnect between the market and the Fed, that tends to lead to a lot of volatility. And if the Fed is really trying hard to communicate, they don't want to do that start, stop you saw in the 1970s. That may mean higher for longer sticks. And if you look at the wage growth, that may mean inflation sticks, and they're going to have to stay higher.
I'm not going to ask you how high or how long. It's a question that I ask everybody, but I want to get to some of these stocks that you're still bullish on. Costco is one that really stuck out to me because earlier this week, Costco fell the most in 6 months as this key sales yardstick weekend. The company does report results next week, but what's got you optimistic about Costco, even with all of these challenges that the company faces?
First off, never doubt Costco. That is like the rule number one. You never doubt Costco's ability to attract growth. But secondly, look, I think they have a very loyal consumer base. They have room to raise their membership rates. They haven't done that. They typically do that every 2 years or so. And so we see that as a potential revenue pickup next year, as well as consumers get squeezed, we feel like they will see in-store pickup again, because consumers are looking for a bargain, are going to look to stretch their dollar as they get a little more squeezed. So yeah, I know the same store comp growth was not a great number. Their stock certainly reflected it this week, but I think they're one of the more resilient stocks and one that has historically had very good downside protection.
So even if we see some kind of recession next year, you think it's still a buy at this point?
I do. And I do think we need to go buy our rotisserie chickens. We need to support Costco.
No. But to be serious, I mean, if we have a much more serious downturn.
Yeah, so if you look at that, what does the consumer do? And we've already seen the consumer start to change their shopping behaviors and what they're buying and what they're spending money on. And I see that when the consumer gets stressed, they're looking for a discount. And I see Costco has pricing power. I know they're reluctant to raise prices, but they may have to. And number two, I think you're going to see the same store pickup, which is what we looked at the comps. That was the bad number that came in this week that kind of shook their stock this week, is that this month over month traffic and comps were not quite as fast growing as people wanted to see. And I think you're going to see that traffic pick up again as we see consumers stressed.
Victoria, just got about 30 seconds left here. JPM is also a name that you like. I know you call these the big old ugly cash cows, whether it's IBM, Costco, JPM, ConocoPhillips. You like these names. Is it the dividend or what is it? Just quickly.
I like cash flow now. I want to be paid now. I'm not paying for I don't want duration. I want everything short and giving me cash now, strong balance sheets, repeatable cash flow, and a way that they can actually grow revenues, which I think all these stocks do, plus strong leadership. I think strong leadership is key. You have to have a CEO who's willing to make tough decisions and speak the truth, which I think these companies have.
Right, and we'll probably see evidence of that coming the next earnings cycle, which is just...
JP Morgan, Jamie Dimon's going to come out and say everything's terrible the week before he announces earnings. That's what he's done the last 2 quarters. So I expect him to say the world is going to be on fire.
Right. Will he say tsunami? Will he say hurricane? That's what we're going to try and figure out, because he likes to use those weather terms. Victoria, thank you so much. Have a great weekend. Victoria Green, she's Chief Investment Officer at G Squared Private Wealth, $575 million in assets under management, joining us via Zoom from College Station, Texas. Stocks bouncing around. We are still off our highs of this session, but a little bit of a gain in the Dow here, Tim.
And the S&P down about 0.1%. The NASDAQ down 0.2%. This is Bloomberg, and it is 3:56 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg Editorial Board. Since the start of the pandemic, Congress has provided public school districts with $190 billion in aid. Yet far too many are in danger of squandering it. A recent McKinsey report found that districts have yet to spend or even budget 1/3 of the funds they've received. At this rate, schools could wind up with as much as $20 billion unspent by September 2024, the deadline for using the funds. School officials need to recognize that this may be their only chance to reverse the harms of the pandemic. Policymakers also need to get serious by ensuring that funds go to classroom instruction and requiring that districts publicize their spending plans. The academic damage caused by the pandemic is immense. Failing to use all available resources to address it would be a tragic mistake. This editorial was written by the Bloomberg Editorial Board. For more Bloomberg Opinion, please go to bloomberg.com/opinion or OPIN Go on the Bloomberg terminal.
This has been Bloomberg Opinion. Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick, Scarlet Fu, we're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast. We decided to bring Carol Massar and Tim Stenovic back despite some of the objections by Scarlett. We welcome our audiences across Bloomberg Television and Radio, as well as on YouTube and Quick Take to parse the most crucial moments of the day and the week. What's going on? You guys are out west, by the way, if anyone cares. They're out in San Francisco getting a read on Silicon Valley. What's happening?
Just trying to get as far away from you as we can.
Oh.
No, I'm only kidding. Only kidding.
I actually do have an observation. It's been a few years since I've been to San Francisco, and Carol and I were driving through the streets yesterday, and we saw one of these self-driving cars being tested. This was a Zoox one.
Yeah.
We pulled out our phones to take pictures of it, and then I realized that every other car is a self-driving car that's being tested. I looked out the window of my hotel this morning,
So
and I
you're
could
the
see
only
like
two people
5 of
driving?
them in the street.
Only humans
I was like,
driving?
well, okay, so this is nothing
Weird.
special, apparently. Yeah.
Decided to check in with us. All right. It just hurts a little bit. What kind of hurts? I don't know whether it hurts. I mean, it's interesting. Some of the top performers in the S&P 500 this week, Scarlett. I just pulled up the list for the week, and you've got names like Etsy, Wynn, Netflix that really saw some outperformance. Bottom of the pack is something like a Costco or a Salesforce. We know some of the reasons why. Some of it was earnings related. Costco is going to report earnings next week, but it's just interesting to see that it was kind of a pivotal week for some of the names.
It was kind of a pivotal, it's been a pivotal year for a name like Netflix, and I'm glad you bring it up because it was one of the worst performers from January until June, and then in the second half of this year, it's become one of the best performers. But we look at the industry performers, and you have materials and industrials leading the way up, and on the downside, energy continues to lag behind, off by 0.6%.
All right, a very wild week here. Of course, we started out on Monday with a big focus here on China and those protests. Wednesday, of course, focused us in on Jay Powell and the Fed messaging. And now here on this Friday, a big jobs report. The market reaction in the futures market, that was actually decidedly negative. But by the time we got to the cash session, that had moderated. The end result of that at the end of the day, a Dow Jones Industrial Average higher by about 0.1%, an S&P lower by about 0.1%, the NASDAQ Composite lower by 0.2%, and a Russell 2000, Carol, up by 0.6%.
Yeah, which leaves you with kind of the similar trade that we got yesterday, right? When you look at the S&P 500, kind of an even split again in terms of names, ending with gains about 245, and then you had about 257 names that were to the downside, Scarlett. So I do feel like investors are just a little bit confused here.
Maybe they've already made their trades for the week and for the year, at least for now, until they get more data points like PPI and CPI next week, certainly PPI first. If you look at the split today in terms of the 24 industry groups in the S&P 500, it's pretty much a mixed day, as you've been mentioning. Materials, household products doing the best by better than 1% gains, while on the downside, you've got banks and chip companies. Chip companies have been under pressure all day today, off by 1%. Carol.
All right, so let's get to some of the individual gainers. And I saw, Romaine, you actually talked about this name earlier, Enphase Energy, top in the NASDAQ 100 and the S&P 500. Stock is up more than 80% so far here in 2022, another 7% gain in today's session. I was looking at some BI research on Enphase in particular yesterday, noting that battery storage and the ramp up could bode well for the likes of Enphase and SolarEdge, given that they are poised to more than double 2023 shipments. But nonetheless, a lot of movement into that name. Of course, we have some government incentives too, right, from the legislation passed earlier. Boeing, an outperformer, it was top in the S&P 500 earlier, up about 4% in today's session. Wall Street Journal initially out with a story reporting that United is nearing a deal to order dozens of 787 Dreamliners. So that certainly could be a plus for Boeing. And then Spectrum Brands climbing about 26%, almost 27% here by the close, on optimism that the deal to sell the company's hardware and home improvement division to Assa Abloy for about $4.3 billion will be completed. So we saw some momentum there in that one.
Pop quiz,
All right, let's take a look.
Pop quiz, Carol. What's the best performing stock in the S&P this week?
Catalent.
Wow, look at that.
She does her homework.
Wow.
She's prepped.
All right,
How'd
moving
you know
on.
that, Carol?
Move on. Just go to
That's pretty impressive. All right, let's talk about some of the decliners. As I mentioned earlier, we did see big tech under pressure. Not the worst performer on a points basis, but the second worst performer. Amazon is the worst performer on a points basis, weighing down the S&P. But Apple down 0.3% today. And interestingly enough, Romaine, we had some unprofitable tech also take a hit today. Asana, but this is a result of the company's most recent report. Shares fell after the company forecast revenue for the fourth quarter below the average analyst estimate. And then the cloud security provider Zscaler also falling more than 10% today. They actually reported results yesterday that came in above estimates. Its forecast revenue came in above estimates. Its forecast for both revenue and earnings came in above estimates, but its forecast for calculated billings fell. That got investors concerned about growth. It fell short of the average analyst estimate at the midpoint, so shares taking a hit today. So a real mixed bag, but investors really bringing that one down by 10.7% today.
A mixed bag, of course, in the Treasury space as well. When you take a look at 10-year yields, last Friday we were at 3.6776. Today we're actually, at 3.4 and change right now. So actually a drop in yields on a weekly basis. Similar story pretty much across the curve here, both on a daily and a weekly basis. But I should point out, sort of the tightness that we've seen, at least here on a day, and at least compared to where we were last Friday, it really sort of misses, I think, all the volatility that we saw in the middle of the week. In fact, the swings that we saw on yields, at least from peak to trough on an intraday basis, some of the widest that we've seen all year. I think something like 32, 33 basis points on the 10-year and around 38, 39 basis points on a 2-year yield here. So a lot of volatility in that space. But the net effect of it, at least on a weekly basis, is that yields actually lower than where they were a week ago.
And you'd mentioned
That's a lot of volatility.
Yeah.
Wow.
You mentioned earlier, Romaine, that that 200-day moving average was something to keep an eye on. The technical levels are really interesting here because we kind of just are staying within very close striking distance of 200-day moving average for the S&P 500, the long-term trend line. And as well, we had the Dow enter a technical bull market in that it was up 20% from its lows. We've reached these kind of technical benchmarks and are just kind of stuck here as we try to suss out what the next direction is for the Fed.
I have to say, I feel like everybody wants to hate this bounce back in stocks. I keep hearing from all of the market strategists, or at least a lot that come on our air, this is a bear market rally. That's how they see it, consistently. But I think about, going back to the fixed income side of thing, that range that you talked about, Romaine, that even though while we ended here on Friday, those are some big swings and just talks to how we are so driven on the news every day, whether it's Fed comments or whether it's economic data, that it really just drives so much uncertainty for investors.
And I think, Carol, go ahead, Romaine.
I just want to point out just real quickly, too, I thought it was interesting, too, to see the pickup in volume. Obviously, last week was distorted because of the holiday, but we had one of the biggest volume days on Wednesday on that Jay Powell meeting. But that volume actually held up on Thursday and this Friday here. So a lot of people are back to trading this market. Whether that's going to end up with up or down still remains to be seen longer term.
Okay, well, let's get back to this idea of whether or not we're in a bear market rally. I mean, shockingly enough, I was surprised to find that from our October lows, we're up almost 17% in the S&P 500 since then. Victoria Green from G Squared was on our air earlier today, and she argues that this is a bear market trap, essentially, and she's urging investors to proceed with caution. She says that she wants to see the S&P 500 move past 4150 on a technical level. That will give her confidence that, we're not going to test new lows.
But did she mention the idea that, when you look at least from the start of this quarter, this has been kind of an everything rally. It's not just energy and tech or some of the things that we were relying on earlier this year.
She was concerned about the idea that we're reaching lower highs and lower lows as well.
Okay.
So I wonder.
No, but it is
pop quiz, Carol.
Again?
Yeah, ask Carol.
The best performing stock quarter to date, so basically since the end of September in the S&P. This is one. It should be close to your heart, Carol.
Carnival?
Close. Royal Caribbean.
Royal Caribbean.
yeah.
Darn it.
Yeah.
That
So
pent-up
close.
demand being unleashed.
Yeah,
I wonder, as we look ahead to next week, and Carol, you made the point that we're data
Stay on your
dependent.
toes. There might be another pop quiz coming.
He's doing all the work for it.
Go, Scarlett, go.
As we look for more data points and more Fed speak, fortunately there won't be any more Fed speak because we're on a media blackout period.
Oh,
But
thank God.
Yeah, data points to trade off of. How much of this is already priced in, right? Because you've got OPEC plus, you've got ISM PMI, you've also got PPI, which probably won't move the market as much as CPI, which will be the next big one.
Yeah, I mean,
oh, go ahead, Romy.
Yeah, I keep interrupting you, Tim, but it's kind of what
That's
I do.
okay.
But yeah, I mean, when we do look forward, I mean, I think Scarlett's on point. I think kind of anything the market can hang their hats on pretty much developed this week. So anything we get next week, maybe it adds, maybe slightly detracts from the narrative, but it's not going to change it fundamentally, I don't think.
I really like the way that Anna Wong, our chief U.S. economist here at Bloomberg Economics, put it. She said that there's something for both team transitory and team persistent coming next week. So,
is there one for team stagflation?
Or team doesn't have a clue. How about that?
Yeah.
Yeah, I think that's kind of where we all are at this point.
You know, the one constant, right? Isn't the World Cup still on? Is that still happening?
Yes, until the 18th.
Speaking of teams,
Scarlett stopped watching after
she's like, I
Iran
can't
lost.
believe you don't.
She's still wearing her Iran colors. Did you notice this every day this week? Do you want to tell us something?
All right, we got to run, guys. We'll be back in New York on Monday. That's a wrap for Beyond the Bell. We'll see you same time, same place on Monday.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Turned out to be a winning week for the Dow, the S&P and NASDAQ, an up Friday for the Dow Jones Industrial Average, a jobs Friday, and it was a down day after all for the S&P 500 index, fluctuating between gains and losses. NASDAQ also had a down day, dropping 21 points to end the week, head into the weekend at 11,461, down today by 0.2%. So on the week, the S&P 500 index was up 1.1%. The Dow this week up 0.2%. The weekly outperformer by far, the NASDAQ Composite Index up by 2.1%. Stocks and bonds saw a lot of instability today after that hot jobs report. Fueled bets of the Federal Reserve will keep tightening even as officials downshift the pace of hikes this month. 10-year yield again 3.48%. Spot gold down $5 the ounce, a drop there of 0.3%. West Texas Intermediate crude down 1.3%. $80.15 a barrel. S&P again lower by 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
From the Bloomberg 99.1 studio in Washington, I'm Nancy Lyons. Here are the day's top news headlines. President Biden is in Boston, where he connected with Britain's Prince William at the JFK Library.
Good to see you again. Good to see you too.
Earlier in the day, President Biden signed into law the rail agreement passed by Congress. He says by implementing the negotiated deal with the rail companies and unions, the country avoided catastrophe that would have lost the economy an estimated $2 billion a day.
Rail shutdown would have devastated our economy. Without freight rail, many of the U.S. industries would literally shut down.
Biden says while the deal does not include 7 days of paid sick leave for rail workers, he promises they will work to approve paid leave for all workers. Well, now that the rail strike has been averted, lawmakers are getting into budget negotiations, starting with their top-line defense and domestic spending figures.
Senate Appropriations Vice Chairman Richard Shelby says there's been a back and forth between Republicans and Democrats over the figures, but they haven't found common ground yet. Shelby has said talks could grow more heated after Georgia's Senate seat is decided next week. House Speaker Nancy Pelosi warned that if lawmakers can't strike an agreement on a full omnibus government funding package, they'll have to rely on a full-year continuing resolution. The deadline is December 16th. In Washington, I'm Amy Morris, Bloomberg Radio.
At the World Cup today, Switzerland beat Serbia, Cameroon beat Brazil, South Korea defeated Portugal, Uruguay beat Ghana, and of course, coming up tomorrow, Team USA will take on the Netherlands in a win-or-go-home game. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Thank you so much. Nancy Lyons in our 99.1 newsroom in Washington, D.C. Carol Masser, along with Tim Stanovic. We are live in our San Francisco Bureau, our 960 studio here on Bloomberg Radio, also on Quick Take on YouTube. And we've got a story that has to do with the San Francisco DA.
Yeah, the San Francisco District Attorney, Brooke Jenkins, has a message about the, quote, lawlessness that she says she inherited in her city. Here's what she said, quote, all crime in San Francisco is illegal again. Changing the perception that San Francisco has lost its allure after the pandemic to help keep the city's economic machine running is a, quote, significant factor that plays into her efforts, Jenkins said in an exclusive interview yesterday here with Bloomberg News.
Yeah, now Jenkins, she's 41. She landed in the city's top prosecutor job by actively helping to unseat her predecessor and former boss, Chesa Boudin, and who was recalled by voters in June amid criticism he was too soft on crime. Now appointed to her post in July by Mayor Breed, Jenkins went on to win election to the remainder of Bowden's term last month, and she will face voters again next year. Am I saying that correctly? You're from the West Coast.
Why would you put me on the spot like that?
I know.
She's pledged to repair what she described as a, quote, dysfunctional relationship between her office and the city police department. She said the city can't afford for business owners to shut their stores and families to flee to the suburbs because they fear for their safety, or for businesses and tourists to avoid the city altogether. I can share with you a story of a friend who actually did move from here during the pandemic. He had this issue. He said that his wife did not feel, they lived in San Francisco, they owned a place.
Yeah.
They left to move to San Diego. He said that his wife did not feel safe walking back to their apartment at night.
That's interesting.
So even though, and we see some anecdotal information about this, and we do hear certainly complaints about it.
Right.
It is affecting people.
Well, it's cities coming after the pandemic. We've talked about this in New York
Right.
City.
Not unique to San Francisco by any means.
And it's funny because someone had warned me about like not walking back to my hotel, and I was talking to someone here at the Bureau, and they're like,
Did you say, come on, I'm from New Jersey?
From New York. And I said, I walk all the time, and they're like, you're going to be fine. And I did it. It seemed okay, but obviously these are things that cities are dealing with and grappling with post-pandemic life. You're listening and watching Bloomberg Business Week.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. A move higher for the Dow. We had the S&P and NASDAQ both declining. Stocks and bonds faced a lot of instability today with that hot jobs report fueling bets the Fed will keep tightening, even if officials downshift the pace of hikes this month. Turned out to be a winning week for the Dow, the S&P and NASDAQ. The Dow this week up by 0.2%. S&P on the week up 1.1%. NASDAQ, though, by far the outperformer this week. Tech stocks rallied with NASDAQ this week up by 2.1%. Today turned out to be a mixed session. S&P ended the day down 4 points, little change, down 0.1%. At the worst level of the day, the S&P had been down 1.2%. Again, the Dow up 0.1%. NASDAQ on this Jobs Friday down 21 points, lower by 0.2%. 10-year yield 3.48%, with the 2-year yielding 4.27%. Spot gold 17.97 the ounce, down 0.3, and West Texas Intermediate crude down 1.3% at $80.10 a barrel. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening and watching Bloomberg Business Week on this Friday. Carol Massar along with Tim Stenovec, and we've got another angle on today's labor report. And, you know, what we saw, of course, you know, the numbers coming in hotter than expected, revisions, higher wages. We're seeing that spike in wages continuing, which we know plays out into overall inflation in the economy. Our next guest has some thoughts on why inflation is tougher actually on working women. So great to have back with us Katika Roy. She's CEO at Pipeline. They use AI to work with companies on gender biases, so they pull in all the data. And she joins us on the phone from Paris. Katika, good to be talking with you again. Tell us a little bit about your perspective on what's going on in the labor market, especially when it comes to women.
Yeah, Carol, thank you. It's great to be here. You know, what we saw in today's jobs report is that across all cohorts of women, they've actually lost jobs. And since the beginning of the pandemic, we actually have 1.8 million women missing from the labor force. And if we brought those 1.8 million women back, we could actually close the gap of workers by almost a quarter. And so we could actually make our jobs market a little less hot.
Katika, to be fair, I do think we're all trying to figure out why so many women and men are staying away from the labor force. We talk about the available labor pool, right? This is so participation. You know, it's been down coming off of the pandemic. What are the reasons that women in particular are not coming back?
Yeah, we have a couple of reasons. You know, one is, certainly childcare has been talked about, and that is part of the solution, but it's not the only solution. There are two pieces. One is actually equity in the labor force, and so this goes beyond pay, but actually ensuring that they have equity of opportunity. Just to give you one example, women are 58% of college graduates, 47% of the labor force, and yet only 8% of Fortune 500 CEOs. That's one. The other piece is skilling. So we actually leaped forward 5 years in terms of digital acceleration during the pandemic. So the jobs that existed at the beginning of the pandemic, don't necessarily exist right now. So we've got a mismatch between skills that companies need and the actual available workers. And so if we skilled folks and ensured equitable skilling, that is equitable access to skilling, but also the ability to apply those skills, we could close that gap and close it quickly.
Hey, Katika, I guess my question would be, what would you recommend to policymakers, given the data that you have and what you know? Like, how do we fix this from a policy perspective?
Well, you know, certainly the pay transparency laws that have both gone into effect and are slated to go into effect on the first of the year are a step in the right direction.
Okay, well, let's break down what we're talking about here, because not everyone knows what those mean. Sure. You're talking about, you know, recently in New York City about a month ago, jobs that were posted for certain companies had to include some sort of pay range. Is that what you're referring to?
Exactly. So on job postings, Colorado was the first state to do that, and then New York City is the second area to do that. And then we've got 3 more states that will go live with that on January 1st. So that's exactly what I'm talking about. And so it's a step in the right direction in terms of putting guardrails up. But what we really need from policymakers is true equal pay.
And we don't have that in the United States. That is actually ensuring that we're paying people equitably, and that companies are proving that they're paying people equitably. And that's not only an issue of fairness, it's actually an issue of economic growth. Because if we close the gender pay gap in the United States, we could close the we could add $512 billion to the U.S. economy, and every American taxpayer subsidizes the pay gap, because women in particular are more likely to rely on social welfare programs.
Katika, one thing I don't kind of get, and if we're relying on policymakers, it may take a little while to get that parity, right? I feel like we've been waiting for a long time already. So, that to me continues to be a slow process. But what about the private sector? And I'm thinking about corporations. We see ESG policies being put out in a big way, DEI policies being put out in a big way. So what's the onus actually on the private sector and companies to really move more aggressively on parity? You work with companies, you look at their data points. What's the conversations that you're having as to why, or what you're hearing as to why companies aren't being kind of better when it comes to making sure there's parity, especially on pay and opportunity for men and women?
Yeah, it's a great question. The issue isn't awareness, it's execution. So about 96% of companies put equity in their top priorities. The issue is that only 22% of employees regularly see it shared and measured. So it's really the difference between employer branding and the employee experience. And what Pipeline, the company that I run, is designed to do is to actually close that gap, which is to get ahead of the decisions that companies are making, to actually ensure that they,
No, I listen to what you say, Katika, like this high idea of they have the awareness, that's pretty high, but it's the execution. And I know this is what you help companies do, but why aren't they executing? If they see the data, they understand, just got about 30 seconds left here, why aren't they doing it?
I think in the past, they haven't had, just in the last month, expanded our offerings to companies that have 200 or more employees, as well as they can get a free equity baseline report. So there's not even a cost to it right now.
All right, we're going to leave it on that note. Katika, always good to catch up with you. Katika Roy, she is Chief Executive Officer, founder of Pipeline, joining us on the phone from Paris. And they go to a company, look at their data points to figure out where there's biases, especially gender bias, and kind of create some enlightenment, if you will, for companies, and then hopefully a change in policies.
I think the pay transparency place is a great place to start. Really interesting to hear the idea that that's going to improve things.
Right, when you see it.
It's fun. It's fun to look.
I bet you have. All right, you're listening and watching Bloomberg Business Week. Carol Master, Tim Stanovic. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130. To Washington, D.C., Bloomberg 99.1. To Boston, Bloomberg 106.1. To San Francisco, Bloomberg 960. To the country, Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening and watching Bloomberg Business Week on this Friday. Carol Massar along with Tim Stanovic. We had some great interviews yesterday.
Yeah, we were at Stanford's Graduate School of Business. It was, once again, for the fourth year in a row, the #1 school in the country when it comes to business school education, according to Bloomberg Business Week. We talked to Dean Jonathan Levin, Mary Barra, Sarah Fryer, and we're going to play some of those interviews for you in the last half hour of our program today.
Coming up in just a moment. Right now, though, let's get another check on how the week ended, the day ended. Here is, once again, Charlie.
Hi, thank you very much. It turned out to be a mixed Friday, but let us begin with the weekly numbers, because for the week, the S&P was up for a second week, up by 1.1%. The Dow this week up 0.2%, but the outperformer by far, NASDAQ Composite Index up this week by 2.1%. Today, S&P was down 5, a drop there of 0.1%. The Dow on this jobs Friday up 34 points, up by about 0.1%. NASDAQ today down 21. That was a drop of about 0.2%. The 10-year yield 3.48%, with the 2-year 4.27%. Spot gold down $5 the ounce to $17.97, drop there of 0.3%. Cannot ignore, by the way, the Russell 2000. It was up today by about 0.6%. Crude oil, West Texas Intermediate down 1.2%, 80.22 a barrel. Again, that 10-year yield 3.48%, with the 2-year 4.27%. Victoria Green is Chief Investment Officer at G Squared Private Wealth, and interviewed right here on Bloomberg Business Week. She told us she believes that we are in a bear market rally.
We're watching it, see if this really invalidated the bear market thesis that we have, and we've run into those resistance levels right there on the downtrend, the retracements, and then the 200-day moving average, and we're really seeing if this is a true breakout or not. And right now I'm still saying no, it's a bear market rally and we're going to reverse, and that's what a lot of people are saying.
Cracker Barrel shares declined today after the restaurant company posted first quarter profit that missed expectations and provided some cautious comments about the rest of the fiscal year. Cracker Barrel today down by 13%. Ford said total U.S. vehicle sales in November dropped 7.8% year over year. Today, Ford shares were down by 1.6%. Recapping winning week for the U.S. stock market, S&P down 4 points, a drop today of 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar, Tim Stanovic, we're out here on the West Coast. The reason we came is because yesterday we spent the day at the Stanford Graduate School of Business, #1 in the U.S. when it comes to MBA programs, as ranked by Bloomberg Business Week for the 4th year in a row. We talked to students, faculty, and, of course, well-known alumni.
One of those was none other than Sarah Fryer. She's the CEO of Nextdoor. And in this excerpt, she discusses the state of play for those ad-based social networks, which have been under quite a bit of pressure this year. Check it out.
For sure, when you look at the whole space, you already mentioned many of the competitors in the space. Advertising is always a place
Thanks,
that
Paul.
people will go to first when they're worried about a recession. And clearly the economic indicators are pointing that way. It's a quick way sometimes to just pull back on more variable spending. That said, in a downturn, you can't afford to completely turn it off. You still need to be driving revenue, and advertisers are mindful of that. It also tends to be, as I tell my team all the time, the first thing that we'll see a recovery in. So whether it's a soft landing in 2023 or maybe a harder landing, and we're out in 2024, ad spending is definitely the one to watch, I think, as a very early barometer on the overall environment. When I talk to advertisers right now, they are focusing on, again, what they can control. So what are the parts of their businesses that are still growing? I was with a bank just yesterday. Clearly, they're not spending as much on mortgage-based advertising, but they're definitely spending in areas like consumer banking and in small business banking, because they know that small businesses are going to need them if times are getting tougher. Just one example.
Sarah, what's the mix between local businesses, advertising from like local businesses versus global companies? Is there a difference in terms of the level of activity that you're seeing or level of slowdown that you're seeing? And what's more important to your business?
For us, it's all about local. Nextdoor is the neighborhood, and that's our unique competitive advantage, being able to bring local at scale The people on Nextdoor today were in 1 in 3 households in the United States. But the people tend to be the household decision maker, right? The person who says, what's going in the fridge? What sort of car am I going to buy? Maybe I'm going to take a vacation, although with the recession coming, maybe I'm not, and I want to do something more locally. So for us, local is certainly what matters. But don't think about it as only, say, smaller companies, because there clearly are global, as you point out, and national brands that want to act local. Walmart is a good example. McDonald's is a great example. Even tech companies like a DoorDash, right? They're all thinking about local and wanting to show up for individual communities, but they need to be able to do that at scale.
And for our viewers and listeners not familiar, you're on the Walmart board, so you definitely have some unique insight into how that company is thinking. Hey, Sarah, I'm curious because, you know, the changes that Apple made to its operating system in the last couple of years, specifically around privacy and IDFA, the challenges that that's posed to Facebook and Snap, that's been really well documented. One thing we've also heard, though, that it's been a challenge for small and medium-sized businesses to actually reach their audience as a result of those privacy changes. Just in the last minute that we have with you, 30 seconds, do you, is that Nextdoor's gain?
It should certainly help us because you're right. I think small businesses were used to a certain level of performance, and we've definitely heard that as we've gone out and done more of our insights-driven research, that all of a sudden they're not seeing that on platforms that they were used to spending a lot on. So again, we come back to what can we do for you as a small local business? Nextdoor gives you a free page, a free presence on the site, a way to talk to the customers that can literally walk into your corner shop, walk into your hair salon, walk into your fitness studio. The second thing we do is very trusted. You know it's real neighbors, real people at a real address. And then finally, there's that community aspect. The thing I always love about local businesses is they're not just there to make a dime. They're also there often to do good in their community. We saw this just through the Thanksgiving period with a lot of businesses giving back, particularly to folks that may not have what they need to put food on the table. We're right now actually offering a small business grant with the NAACP to really get to minority businesses as well. So just some examples of how Nextdoor can help local businesses at a local level.
All right, that was the chairman, president, and CEO of Nextdoor, Sarah Fryer, from our broadcast at Stanford Graduate School of Business. You can hear the entire interview on our podcast feed at Bloomberg.com or wherever you get your podcasts. She's in a tricky market.
It is a really tricky market if you're an ad-based social network. Hey, she spent years at Square, Carol, where she was acting COO. She was CFO as well. This under Jack Dorsey, of course. She took this from a company that was 200 people when she started to a company of thousands of people and took it public as well. A really interesting background, and like you said, in a tough place though with the ad-based social networking market where it is today.
And you know, not just her, right? Like we talk about it, whether it's Meta or anybody who's based on ads on the online world, they're certainly having a tricky time right now. All right, you are listening and watching Bloomberg Business Week. Carol Massar along with Tim Stanovic. A lot going on in the world, and we want to get a check on world and national news for you. For that, we're heading over to Nancy Lyons. She's in our 99.1 newsroom in the nation's capital. Hey, Nance.
Thanks, Carol. Democrats have voted to move the South Carolina primary to the front of their presidential nominating calendar, displacing Iowa in a bid to involve more minority voters. Iowa has kicked off the process for 50 years. Well, President Biden has signed into law the newly approved bill averting a rail strike, even though he admits it did not include everything workers wanted. Labor Secretary Marty Walsh is also defending the deal.
It wasn't like it was a bad contract. 24% increase, 85-15% split on health care, which they preserved. They were able to get some work rules changes. They were able to get 3 unpaid days off.
Labor Secretary Marty Walsh tells Bloomberg he's encouraging the unions to press rail executives to improve sick leave policies and ramp up hiring. The U.S. economy continues to grow both in gross domestic product and employment, while the Federal Reserve keeps trying to slow it down.
Americans continue to spend down their savings, but that will soon apply only to those with high incomes. Diane Swank, chief economist of the firm KPMG, said in a Bloomberg interview.
Part of the reason spending has held up so much this year is that we've created over 4.3 million new jobs. That is a stunning number of new paychecks, holding up aggregate incomes, even as individuals feel that they've lost ground, justifiably so, on their wages relative to inflation.
Swank said low-income people are beginning to use credit to buy groceries, and job growth is going to slow to a halt before very long. In Washington, Irv Chapman, Bloomberg Radio.
At the World Cup today, Switzerland beat Serbia, Cameroon beat Brazil, South Korea defeated Portugal, and Uruguay beat Ghana. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nancy, thank you so much. Nancy Lyons in our 99.1 newsroom in the nation's capital. Carol Masser and Tim Stanovic out here on the West Coast. And on this Labor Friday,
ooh, nice.
There are some job openings out there.
Yeah, how's this for a job opening? Help wanted. There's nothing I hate more than rats. If you have the drive, determination, and killer instinct needed to fight New York City's relentless rat population, then your dream job awaits. That dream job, NYC Rat Czar. And that job description coming from none other than Mayor Eric Adams.
Yeah, Mayor Adams, looking for a leader in the city's war on rats, wants someone who is somewhat bloodthirsty and, as you said, committed to the wholesale slaughter of vermin. If you live or work in New York City, part of the fabric is the New York City rats. You see them in Central Park, you see them in the subway, but they've gotten a little bit out of hand, especially post-pandemic.
A little aggressive in this day and age. I don't know if you've ever had one run across your foot, but I have. That's no fun, but that's sort of a rite of passage for every New Yorker. That happened the first, few months that I lived in the city, and I'm still here.
That was called the New York City Orientation.
Yeah, thanks for the welcoming committee. I have a soapbox to stand on, though, Carol. One of the reasons we have such a rat problem in New York City is because we leave our trash on the street in bags.
Yeah.
So if we took some steps to maybe do what other countries do in other cities around the world, which is put dumpsters on every few blocks and instead throw our trash into those dumpsters, then perhaps we wouldn't have such a rat problem.
All right, I don't really want to hear about this. What I really want to hear about is that the job description is filled with rodent puns and anti-rat epithets. As leader of the rat pack, you will work with your colleagues from across city government, traveling throughout the 5 boroughs. Among the job qualifications are a swashbuckling attitude, crafty humor, and general aura of, I can't say the word, bad airy.
Okay.
And proficiency with Microsoft Word.
$120K to $170K a year, and you report to the deputy mayor for operations.
How
120 to 170. It's pretty good.
That's not too shabby.
No.
Anyway, we need a rat czar in New York City, something I'm looking forward to as I head my way back.
No
to
rats
the
can
East
apply.
Coast. All right, you're listening and watching Bloomberg Business Week on Bloomberg.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Headquarters, I'm Charlie Pellet. The Dow higher, S&P, NASDAQ both lower today. That hot jobs report fueled bets the Fed will keep tightening, even if officials downshift the pace of hikes this month. The S&P was lower by 4 points today, down 0.1%. The Dow up today by 0.1%, higher by 34 points. NASDAQ had a down day. NASDAQ Composite Index today down 21 points, a drop there of about 0.2%. 10-year yield for 3.48% on the 10-year, with a 2-year 4.28%. Spot gold $17.98 the ounce. Bitcoin today up 0.5%, 17,008 right now on Bitcoin. West Texas Intermediate crude down 1.3% today. WTI $80.18 a barrel. Turned out to be a mixed Friday here. Winning week for the S&P this week, higher by 1.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, thank you so much, Charlie. As we mentioned, we spent the day yesterday at the Stanford Graduate School of Business, talked to so many, including prominent alum, and that includes Mary Barra. She's the chairman and CEO of General Motors, making big changes, you know, at that automaker since becoming CEO back in 2014. She is a Stanford Graduate School of Business alum, as I mentioned, class of 1990. And in this excerpt from our conversation, she talked 2023 strategy and also her plans for the EV market. Check it out.
We're still seeing very strong demand and pricing. It's moderated a little, but still well ahead of levels that were pre-COVID and pre the semiconductor shortage. So it's something we're continuing to watch on a daily basis. But for the auto industry, we're seeing a little bit from a used car pricing, but still very strong demand.
How does that change your outlook at all for 2023 and what you're expecting next year? Give us an idea of indicators that you're watching.
Sure. Well, one of the things is we are planning for, we decided to put our plan around a more conservative market, around 15 million SAAR, which is the seasonal adjusted sales rate. And because we understand that, if we set everything up, if there's more opportunity, we'll be able to seize the opportunity. But we're taking the approach that we're going to be very mindful of cost as we go into next year. We have a strong product portfolio with new mid-sized trucks coming off of, new trucks that we've just launched this year. So we're confident in our product portfolio, but we're going to be conservative with costs.
Mary, you guys just gave us an update just a short time ago, and you talked about your EV, expectations. One thing we wanted to ask you, some of the things that General Motors has talked about, those EV incentives, thanks to the Inflation Reduction Act, it has said that you guys will do EVs, will reach parity with conventional cars, will help profits reach parity between EVs and conventional cars. Does that mean that General Motors thinks it will sell 1 million EVs in 2025 without those incentives? I wonder if you could give us some clarification and color on that.
Well, we made that statement and that set that goal for ourselves that we'll have the capacity to be able to sell 1 million units in North America and, frankly, in China by 2025. And we think with the strong product portfolio we're going to have at different price points, from the Cadillac Lyriq to the Hummer, the Chevy Silverado, the GMC Sierra, down to a Chevy Equinox and a Chevy Blazer, we're going to have the products across the market that are going to allow us to achieve that metric. So we think we've got the right plan. This was all in place before the incentive package came as a part of IRA, but we think that will help, and it's doing what it was supposed to. We think it was intended to do, was to drive EV adoption, and we've invested a lot in the United States creating jobs, which I think is going to create a stronger economy. So I think it's going to accomplish the objectives, and it happened to be very aligned with the plan we were already executing.
Do those incentives, though, help margins? It's not a bad thing to have, right?
Well, no, because if you think about it, from an electric vehicle perspective, the battery is the most expensive piece, and where everyone is working to improve battery technology. I think General Motors is in a leading position or among the leaders from a battery cost perspective. Our plant in Ohio is now producing cells, so that's a big advantage, and we have another plant coming on next year and the year after. So I think that's going to be important, but to really get all companies and consumers to move forward to EVs. I think this is very important. So yes, we think that it will be helpful and allow us to continue to invest in the United States.
I do want to talk a little bit more about that battery plant in Ohio, the Ultium battery plant in Lordstown, Ohio. Next week is set to vote on whether or not to join the union, workers there, that is. This is a big deal. It's the first battery plant to have a vote in North America. Do you think the EV business will include the union? And is it good for America to have a union involved in this?
Well, we're very supportive of the plant being unionized. We have a very productive relationship with our labor partners around the globe. We work together on safety, which I think is fundamental, on quality. And so, obviously the employees are going to be voting, but we're very supportive.
Mary, one thing, and it looks like maybe this issue is being dealt with, because, it's funny, we talked with John Levin, the dean of Stanford Graduate School of Business, about just how they get students ready for just so many different things that's going to potentially come at them as leaders. And I was just thinking about the rail strike, like leading up to this interview with you. It looks like from Chuck Schumer that maybe we can put this to rest. But have you guys been strategizing around that and at the impact it could have on GM if indeed it went down?
Oh, absolutely. We've been, even several weeks ago when the first deadline came up, we're watching it very closely. We're encouraging the parties to find an agreement. It will have an impact. There's, when you look at how parts and product are moved across the country, it will have a significant impact. But we've done the planning that we can, and we understand, and also are having the right communication with the rail companies.
That was Mary Barra, the chair and CEO of General Motors, from our broadcast at the Stanford Graduate School of Business. You can hear the entire interview. Just head to our podcast feed at Bloomberg.com or wherever you get your podcasts. All right, well, that's a wrap for us from the West Coast.
It is. We had a good time this trip. A lot of rain, Carol. I don't know if you heard in that interview, if you were listening, the sound of the pitter-patter of the raindrops yesterday. It was a big storm going through Northern California. That left a lot of rain. But as I said throughout the day yesterday, the city, the state, and actually the entire region needs it because they're going through a big drought.
I have to say, I've come to the West Coast a lot over the last 10 years, and that was the first time I remember ever
because
being
it never rains
in
here.
A downpour. And we've done so many broadcasts from Stanford because they've been #1 for 4 years in a row, and we've never had to deal with that. I remember one where it was smoke because of nearby fires. And that was certainly troubling and concerning, but it's just a reminder of kind of all of the climate issues that the West Coast is dealing with. Can we just tee up our weekend show? Because
yeah, let's do that.
We have the cover of Bloomberg Business Week. It's about TikTok. It's an incredible story by Olivia Carville, concerns about TikTok videos that are out there, the TikTok challenges, and what's happening to some really young kids who are actually taking their lives as a result. On the flip side, and a very investment-led story, and that has to do with Kathy Wood of ARK Invest. We caught up with her just before Thanksgiving, a very long conversation covering everything from Tesla, Elon, Twitter, and of course, SBF and FTX.
Yeah, she's sticking by that call for Bitcoin to hit $1 million. So interesting to hear that.
Why.
She did, and and it's come at a time where I think it was yesterday Mike Novogratz pulling back on his estimate for Bitcoin reaching higher levels.
Yeah, I will say she often takes a position on something and sticks to it. She has a very long-term investment theory when it comes to it. Speaking of, we just heard from Mary Barra. One of the names, though, that Kathy's been buying is General Motors. So if you go to our podcast feed, you can hear the entire conversation with Kathy as well and hear why, some of the reasons why she's been doing it. And then coming up next week, we've got some economic data points, some earnings, so a lot to get to.
And then there's that Georgia election runoff that is very important. It turns out that if Raphael Warnock does beat Herschel Walker, the Democrats will have a firm majority. So they won't need Kamala Harris, vice president, for her tie-breaking vote.
All right. Be sure to check out our weekend show. You can catch it on Bloomberg Radio, 8 a.m. on Bloomberg Radio and also on our podcast feed. For Tim Stanovic and the whole Business Week team, have a great weekend and safe one. I'm Carol.